The 10 numbers that'll save your business, key risk indicators you can't ignore. You know what's interesting? I can usually tell within about 15 minutes whether a small business is going to make it long-term or not. And it's not about how busy they are, or how passionate the owner is, or even how good their product is. It's about whether they can answer 10 specific questions about their business. Not complicated questions, not MBA-level financial theory, just 10 straightforward numbers that tell you whether you're building something sustainable or just riding a wave that's about to crash. I was talking to a contractor recently. Does beautiful work, books solid for months out, customers love him. And I asked him what percentage of his revenue comes from his top 3 customers. He had no idea. Turned out when we calculated it, 73% of his revenue came from 2 commercial clients. One of them went bankrupt 4 months later. His business nearly went with it. That's what we're getting into today. The 10 key risk indicators that every small business owner needs to track, document, and actually understand. Not the vanity metrics that make you feel good. The real numbers that tell you when you're in trouble before it becomes obvious to everyone else. These aren't just interesting data points. These are early warning systems. And the scary part? Most small businesses don't track any of them. Real quick, if you're running a small business and you're realizing you might be flying blind with some of this stuff, hit that subscribe button. I put out videos every week on the operational and financial risks that can kill an otherwise solid business. And drop a comment below. Which of these 10 indicators do you already track? Which ones are you realizing you need to start watching? I will read every comment, and it helps me understand what content you actually need. Here's the thing about risk indicators. They're different from performance indicators. Performance indicators tell you how well you're doing. Risk indicators tell you when you're exposed, when you're vulnerable, when something bad could happen even if things look fine right now. Most business owners obsess over revenue. We did 100K this month. Okay, great. But did you make any money? Are you going to collect it? Is it sustainable? Revenue is a performance metric. It tells you nothing about risk. The indicators we're going to walk through are the ones that predict problems. They're leading indicators, not lagging ones. And the key is documenting how you calculate them and then actually reviewing them consistently. Not just when you remember, not just when things feel off, consistently. Let me walk you through all 10. And I'll explain why each one matters and what I've seen happen when businesses ignore them. Indicator 1, customer concentration. This is the big one that nobody talks about. Customer concentration is what percentage of your revenue comes from your largest customers. I usually look at the top 3. Here's the rule of thumb I use. If more than 30% of your revenue comes from any single customer, you don't have a business. You have a dependency. If your top 3 customers represent more than 50% of your revenue, you're exposed. Why does this matter? Because customers leave. They go out of business, they change vendors, they get acquired, and the new owner has different relationships. It happens. And when a customer that represents 40% of your revenue leaves, you can't replace that overnight. Use case. There's a software development shop that had a beautiful setup. One major client, paying them about $60K a month for ongoing development and support. Steady, predictable income. The owner was paying himself well, hired a few developers, everything seemed great. That client got acquired, the acquiring company had their own development team, 30 days notice, gone. The business went from comfortable to crisis in a month, had to lay off developers, owner stopped taking a salary, they were scrambling to find new clients, but that takes time. They survived, but barely. Took them almost a year to replace that revenue. The killer? They saw it coming and did nothing. The client had been shopping themselves for acquisition for 6 months. It was practically public knowledge, but the owner didn't have customer concentration documented as a risk indicator, so he wasn't actively thinking about it, he wasn't diversifying, he just hoped it wouldn't happen. How you document this? Simple spreadsheet. Customer name, annual revenue from that customer, percentage of total revenue. Update it monthly. Set a threshold, say 25% for any single customer, and when you hit it, that triggers a documented business development plan to diversify. You're not saying you won't work with large customers. You're just saying you need to know when you're exposed and have a plan. Indicator 2, cash runway. This one's straightforward but critical. Cash runway is how many months you can operate at your current burn rate with the cash you have in the bank. The calculation is simple. Cash on hand divided by monthly operating expenses. If you've got 100K in the bank and you spend 25Ks a month, you've got a 4-month runway. Here's what's tricky. Your expenses aren't always consistent. You might have quarterly insurance payments, annual software licenses, seasonal labor costs, so you need to calculate this based on your actual average monthly cash outflow, not just your regular monthly expenses. I see businesses all the time that look at their bank balance and feel comfortable. We've got 200K in the bank, we're fine. Then you dig into it, and they've got 80K in payroll taxes they haven't remitted yet, 30K in accounts payable that's overdue, and 40K in owner's draws that were really loans that need to be repaid. Their actual available cash is 50K, and their monthly burn is 40K. They're 5 weeks from disaster, not comfortable. Use case. There's a retail operation I know that expanded from 1 location to 3. They calculated their costs for the new locations, they had a plan, everything looked good on paper. What they didn't account for was the ramp-up time. New locations take a while to hit their stride. They tracked their cash balance, but not their runway. They saw the cash going down but thought, we're growing, that's normal. By the time they realized they were 6 weeks from not making payroll, their options were limited. They ended up having to close one of the new locations, fire a bunch of people, and take out an expensive short-term loan. If they'd been tracking runway as a risk indicator with a threshold of, we need to take action if we drop below 3 months, they would have seen the problem at month 4 or 5 and could have adjusted course. Maybe slower expansion, maybe a line of credit secured when they didn't need it, maybe different pricing, something other than emergency measures. How you document this? Update this weekly. Cash on hand as of today, divided by average monthly cash outflow over the last 3 months. When it drops below 3 months, you're in yellow alert mode. Below 2 months, red alert. Have documented protocols for what actions you take at each threshold. Indicator 3, gross margin variance. This one's subtle, but it'll kill you if you don't watch it. Gross margin is your revenue minus your direct costs. What's left after you pay for the stuff or labor that directly generates the revenue. It's usually expressed as a percentage. But here's what matters for risk. It's not your overall gross margin. It's the variance in your gross margin month to month or job to job. If your gross margin is consistently 40%, great. You can plan around that. But if it's 50% one month, 30% the next, 45% the month after that, you've got a problem. That variance means you don't actually understand your costs, or your pricing is inconsistent, or you've got process problems. Use case. There's a custom fabrication shop I know that thought they were doing fine. Their annual gross margin was right around 35%, which was okay for their industry. But when we started tracking it monthly, it was all over the place. Some months were 50%, some were 20%. Turned out they were quoting jobs based on rough estimates and hope. When the job was simple, they killed it. When the job had complications, which happened a lot, they ate the overruns because they'd already quoted the price. They thought they were just having unlucky months. Really, they had a process problem. We documented a proper job costing and estimating process, not complicated, just tracking actual labor hours and material costs per job versus estimates, and adjusting the estimation model. Within 6 months, their margin variance dropped from 15 percentage points to about 5. Their average margin actually went up to 38% because they weren't underbidding the complicated jobs anymore. The risk indicator here isn't just what's your margin, it's how consistent is your margin. Big variance means you've got processes that aren't documented or understood. You're winging it, and eventually that catches up with you. How you document this? Track gross margin monthly. Calculate the standard deviation if you're fancy, or just eyeball whether it's bouncing around more than 5 to 8 percentage points. When variance is high, that's your signal to dig into job costing and figure out where the inconsistency is coming from. Indicator 4, days sales outstanding. This is how long it takes you to collect payment after you invoice. It's called DSO in accounting terms, but just think of it as, how long am I waiting to get paid? The formula is accounts receivable, total credit sales, X number of days in period. So if you've got 50K in outstanding invoices and you did 150K in credit sales last quarter, that's 50K's 150K x 90 days, shark 30 days DSO. Here's why this matters as a risk indicator. When DSO starts creeping up, it's usually a leading indicator of either collection problems or customer financial trouble. Your customers are taking longer to pay. That's a red flag. I see businesses all the time where DSO goes from 30 days to 45 days to 60 days, and they don't notice because they're focused on sales. Then suddenly they've got a cash crunch and they're surprised. But the warning sign was there months earlier. Use case. There's a marketing agency I know that did great work for small business clients. They tracked their sales, their revenue, their expenses. They felt good. DSO was creeping up, but they didn't track it formally. They went from an average of 35 days to over 70 days over about 18 months. Didn't seem like a crisis because it was gradual. Then one quarter, 3 major clients couldn't pay on time because of their own cash flow issues. The agency had basically been extending them longer and longer payment terms without realizing it. They ended up with over 200K in receivables that were 90+ days old. Some of it they never collected, and in the meantime, they still had to make payroll and pay their bills. They survived, but it was ugly. Stopped taking new projects, had to lay off people, owner didn't pay himself for 4 months, all because they weren't tracking DSO as a risk indicator. If they'd been watching it and set a threshold, say, we take action if DSO goes over 45 days, they could have tightened up their collection processes, been more selective about clients, required deposits or progress billing, something other than crisis management. How you document this. Calculate DSO monthly. Set a target based on your payment terms. If your terms are net 30, your DSO should be 35-40 days max. When it goes over your threshold, that triggers documented collection actions. More frequent follow-up calls, tighter credit policies, whatever your plan is. Indicator 5. Operating expense ratio trend. Operating expenses are everything that's not directly tied to making your product or delivering your service. Rent, admin salaries, marketing, insurance, utilities, software subscriptions, all the overhead. Operating expense ratio is those expenses divided by revenue, expressed as a percentage. If you've got 50K in operating expenses and 200K in revenue, that's 25%. The risk indicator isn't the ratio itself. Different businesses have different healthy ratios. The risk indicator is the trend. Is it going up? If your operating expense ratio is creeping up over time, you're getting less efficient. You're spending more on overhead relative to revenue. This is really common in growing businesses. You add an admin person, you upgrade your software, you move to a bigger office. Each decision makes sense in isolation, but collectively they're increasing your fixed costs. And if revenue doesn't keep pace, you've got a problem. Use case. There's a consulting. 3 partners, doing well, growing revenue about 15% per year. They were tracking revenue and profit, but not the operating expense ratio trend. Over 3 years, their operating expenses went from 35% of revenue to 48% of revenue. They'd added staff, got a nicer office, bought better equipment, increased their marketing budget, all reasonable decisions. But their revenue growth wasn't keeping pace with their expense growth. By year 3, their profit margin had shrunk from 25% to about 12%. They were making more revenue but taking home less profit. They felt like they were working harder for less money because they were. When they documented their operating expense ratio as a monthly tracked metric, it became obvious. They made some tough calls, downsized the office, eliminated some underutilized software subscriptions, restructured their admin support. Got the ratio back down to 38% over about 6 months. Profit margins recovered. The key is catching this early. When you see operating expenses increasing faster than revenue for 2 or 3 quarters in a row, that's your signal to scrutinize every expense and make some cuts before it becomes a crisis. How you document this. Track this monthly. Operating expenses as a percentage of revenue. Chart it over time. You're looking for the trend, not the absolute number. When you see 3 consecutive months of increase, that triggers a documented expense review process. A quick pause here. If you're finding this useful, if these indicators are making you realize you've been missing some warning signs in your own business, hit that like button. It helps more business owners find this content. And drop a comment about which indicator surprised you or which one you're most worried about now. The engagement really does help, and I respond to every comment. Indicator 6, Customer Acquisition Cost to Lifetime Value Ratio. Okay, this one's a mouthful, but it's critical. Customer acquisition cost, CAC for short, is what it costs you to get a new customer. Marketing spend, sales time, proposals, everything that goes into winning a customer. Customer lifetime value, LTV, is how much profit that customer generates over their entire relationship with you. The ratio is LTV divided by CAC. You want this to be at least 3.1. For every dollar you spend acquiring a customer, you should get at least $3 in lifetime profit. If you're below that, you're in trouble. Here's the risk. Most small businesses don't track this at all. They spend money on marketing because they need more customers, without knowing whether they're actually making money on those customers over time. Use case. There's a gym that was doing Groupon deals and Facebook ads to get new members. They were tracking how many new members they got each month. They weren't tracking how much it cost to acquire each member or how long members stayed. When they actually ran the numbers, their CAC was about $180 per member. That's the marketing cost plus the staff time to do tours and sign people up. Their average member stayed for 7 months and paid $40 per month, so LTV was $280 in revenue. But when you subtract the direct costs of servicing a member, about $15 per month in variable costs, the lifetime profit was only $175. So they were spending $180 to make $175. They were losing money on every new customer. The only reason they were surviving was because they had some long-term members from before they started the aggressive marketing. They were literally buying their way out of business. They killed the Groupon deals, adjusted the Facebook targeting to focus on people more likely to be long-term members, and implemented a referral program that had lower CAC. Got the ratio to about 2.5 to 1. Not ideal, but sustainable. The risk indicator here is when your ratio drops below 2 to 1. That means you're either spending too much to acquire customers or not extracting enough value from them. Either way, it's not sustainable. How you document this? Calculate CAC monthly, total marketing and sales costs, divided by new customers acquired. Calculate LTV based on your average customer retention period and profit per customer. If you don't know retention rates, start tracking when customers come in and when they leave. Update this quarterly and set a threshold where you reevaluate your marketing strategy if the ratio drops below 2 to 1. Indicator 7, Debt Service Coverage Ratio. If you've got any debt, loans, lines of credit, equipment financing, you need to track your debt service coverage ratio. This tells you how easily you can cover your debt payments with your operating cash flow. The formula is net operating income divided by total debt service. If you're making $100K in operating income and your debt payments are $30K per year, your ratio is 3.3. That means you're making 3.3 times more than you need to cover your debt. That's comfortable. Banks typically want to see at least 1.25. Below 1.0 means you're not generating enough cash to cover your debt payments, which is a crisis. The risk indicator is when this ratio starts dropping. Even if you're above 1.25, if you were at 2.5 a year ago and you're at 1.5 now, that's a trend that predicts problems. Use case? There's a manufacturing company I know that took on equipment financing to expand capacity. Smart move. They needed the equipment to take on larger orders. Their debt service coverage was comfortable at 2.8 when they took on the loan. Over 2 years, it dropped to 1.4. Still above the bank's requirement, so they weren't in violation of anything. But revenue wasn't growing as fast as they'd projected, and operating costs were higher than expected. They didn't track this as a risk indicator, so they didn't see the trend. Year 3, they had a couple slow months. Ratio dropped to 0.9. Now they couldn't cover their debt payments. They had to have really uncomfortable conversations with their bank, restructure some of the debt, and cut costs aggressively. If they'd been tracking this quarterly and set a threshold, say, we investigate if it drops below 2.0, They could have made adjustments earlier, maybe cut some discretionary spending, maybe focused more on sales, maybe refinanced before they were in crisis mode. How you document this? Calculate quarterly if you have debt. Net operating income from your P&L divided by annual debt service payments. Chart the trend. When it drops more than 0.5 in a single quarter or shows a declining trend over 2 quarters, that triggers a documented review of your debt structure and cash flow projections. Indicator 8, inventory turnover. If you carry inventory, whether that's products for resale or materials for production, you need to track how fast you're turning it over. Inventory turnover is cost of goods sold divided by average inventory value. So if you sold $500K worth of product at cost, and you typically have $100K worth of inventory on hand, your turnover is 5. You're turning over your inventory 5 times per year or about every 10 weeks. Why does this matter as a risk indicator? Because inventory is cash sitting on a shelf. If your turnover is slowing down, that means either you're buying too much or you're not selling as fast. Either way, you're tying up cash in inventory that could be used elsewhere. Slow-moving inventory is also a quality problem waiting to happen. Products expire, become obsolete, get damaged. The longer inventory sits, the more likely you're going to have to write some of it off. Use case. There's a specialty food retailer I know that wasn't tracking turnover. They had a beautiful store, curated products, good foot traffic. They thought they were doing fine. When they analyzed their inventory, their overall turnover was decent, about 8 times per year. But when you broke it down by category, they had some products turning over 20 times per year and others turning over twice per year or less. All that slow-moving inventory was tying up about $60K in cash. Some of it was approaching expiration dates. They were making frequent trips to suppliers because they were always out of the fast-moving stuff, but their warehouse was full of things nobody wanted. They implemented a simple inventory tracking system, monitored turnover by category monthly, set a threshold. Anything that hadn't sold in 90 days got marked for clearance, got their cash freed up, reduced waste, and actually improved their product selection because they were stocking what actually moved. The risk indicator is when overall turnover is declining, or when you've got significant portions of inventory that aren't moving. Both suggest you've got cash tied up unproductively. How you document this? Calculate monthly or at least quarterly. Overall inventory turnover, and if you can, break it down by major category. When turnover drops more than 10% from your baseline, or when you've got inventory sitting for more than twice your normal turnover period, that triggers a documented review and potentially a clearance plan. Indicator 9, employee turnover rate. This one's about people, not just money. Employee turnover rate is the percentage of your workforce that leaves over a given period, usually calculated annually. Number of employees who left, average number of employees, x 100. So if you had 10 employees on average and 3 left during the year, that's a 30% turnover rate. Why is this a risk indicator? Because high turnover is expensive. There's the direct cost, recruiting, hiring, training, which is usually estimated at 50–200% of an employee's annual salary, depending on the role. But there's also the indirect cost. Loss of institutional knowledge, decreased productivity while new people ramp up, impact on team morale, potential quality issues. More than that, though, high turnover is usually a symptom of deeper problems: poor management, low pay, lack of growth opportunities, bad culture. Whatever the cause, it's a risk to your business stability. Use case. There's a landscaping company I know that was struggling with turnover. They'd hire crew members, train them up, and 6 months later, they'd leave. The owner thought it was just the nature of the industry. Landscaping has high turnover, right? When they actually tracked it, they were at 80% annual turnover. Industry average is more like 40–50%, which is still high but manageable. At 80%, they were constantly in training mode. Quality was inconsistent. Customer complaints were up because every job had at least one new person who didn't know the systems yet. The financial impact was bigger than they realized. They were spending probably $4,000–$5,000 per hire in recruiting and training costs. With 10 employees and 80% turnover, that's 32K, 40K per year just on churn, plus the lost productivity, the quality issues, the owner's time managing the constant turnover. They dug into why people were leaving. Turned out pay was below market, there was no clear growth path, and the work wasn't being scheduled well, so people had inconsistent hours. All fixable problems, but they didn't know about them because nobody was tracking turnover as a metric or doing exit interviews. They raised pay by 12%, implemented a clear path from laborer to crew lead, and got better at scheduling. Turnover dropped to about 35% over the next year. That saved them probably $25K directly in recruiting and training, plus all the indirect benefits. The risk indicator is when turnover is trending up or when it's significantly above industry norms. That tells you something's wrong before it becomes a crisis. How you document this? Track departures monthly. Calculate the rate quarterly or annually. Also track voluntary versus involuntary. If everyone's quitting voluntarily, that's a different problem than if you're firing people. When turnover exceeds industry benchmarks or shows an upward trend over 2 quarters, that triggers documented retention initiatives and possibly exit interviews to understand why people are leaving. Indicator 10, project or job profitability variance. This last one is for businesses that work on a project or job basis, contractors, agencies, professional services, custom manufacturing. You need to track not just overall profitability, but profitability by job. The risk indicator is the variance. If some jobs are making 40% margin and others are losing money, you've got a problem, even if your overall margin is okay. This tells you several things. Are you estimating accurately? Are certain types of jobs or certain customers consistently unprofitable? Is there scope creep happening that you're not capturing? Use case. There's an architectural firm that was profitable overall, about 15% net margin, which is decent for their industry. They thought they were doing fine. When they analyzed profitability by project, it was a disaster. About 30% of their projects were making 30–40% margins, about 50% were making 10–15%, and about 20% were actually losing money, like negative 10–20% margins. The unprofitable projects were killing them. If they just hadn't done those projects at all, their overall margin would have been about 23% instead of 15%. They were working their tails off on projects that were making them worse off. Turned out the unprofitable projects had some common characteristics. They were usually residential projects, small, lots of change orders, clients who didn't understand the process. The profitable projects were mostly commercial, larger budgets, more professional clients, clearer scopes. They made a strategic decision to stop taking residential projects under a certain size and to implement much more rigorous change order tracking on the ones they did take. Within a year, they'd essentially eliminated the unprofitable project category. Their overall margin went up, they were less stressed, and ironically, they were doing less work but making more money. The risk of not tracking this is that profitable work subsidizes unprofitable work, and you don't know it. You're busy, you're bringing in revenue, but you're not actually building wealth efficiently. How you document this? Track actual costs versus estimated costs for every job. Calculate final margin when the job is complete. Look for patterns. Are certain job types, customers, or team members consistently associated with low or negative margins? When variance is high or when a significant percentage of jobs are unprofitable, that triggers a documented review of your estimating process, your project management, or your customer selection criteria. So let us bring all this together. Here's what I want you to understand. These 10 indicators aren't just interesting numbers to know. They're your early warning system. They tell you when you're exposed, when you're trending the wrong direction, when you need to make changes before those changes become forced on you in a crisis. The businesses that survive and thrive don't necessarily avoid risks. They see risks coming. They have systems in place to monitor these indicators. They have documented thresholds that trigger action. They're proactive instead of reactive. And here's the thing, setting this up isn't complicated. You're not building some enterprise-grade business intelligence system. You're literally talking about a spreadsheet with 10 numbers that you update monthly or quarterly. But you have to do it. You have to document the process for calculating each indicator. You have to assign responsibility for updating them. You have to review them consistently. That's the discipline part. I see business owners who spend hours tweaking their logo or obsessing over their website, but won't spend 1 hour a month reviewing their risk indicators. That's backwards. Your logo doesn't tell you when you're 6 months from a cash crisis. These indicators do. The implementation path. So where do you start? Don't try to implement all 10 at once. Pick 3 that are most relevant for your business type. If you're project-based, start with customer concentration, job profitability variance, and gross margin variance. If you're product-based, start with inventory turnover, cash runway, and operating expense ratio trend. If you're service-based with recurring revenue, start with customer concentration, DSO, and employee turnover. Document how to calculate your 3 chosen indicators. Set up a simple spreadsheet. Determine your thresholds. What number makes you take action? Update them monthly for the first 3 months to get a baseline. Then start actually managing to them. Once those 3 are routine, and by routine I mean you're updating them without thinking about it and you're using them to make decisions, add the next 3, then the final 4. Give yourself 6 months to get all 10 fully implemented and integrated into how you run the business. That's reasonable, that's achievable, and that's transformational. Closing, the call to action. Look, running a small business is risky, that's just reality, but running it blind is reckless. These 10 indicators give you visibility into risks before they become crises. Customer concentration tells you when you're too dependent. Cash runway tells you when you're running out of time. Gross margin variance tells you when your processes are broken. DSO tells you when collection problems are brewing. Operating expense ratio tells you when you're getting inefficient. CAC to LTV tells you when your growth isn't sustainable. Debt service coverage tells you when you're over-leveraged. Inventory turnover tells you when cash is tied up unproductively. Employee turnover tells you when culture or compensation problems are costing you. And job profitability variance tells you when you're working on the wrong things. 10 numbers, updated consistently, managed proactively. That's the difference between businesses that grow profitably and businesses that just stay busy until they don't. If you want more content on the operational and financial discipline that separates successful businesses from struggling ones, the stuff that nobody teaches you when you start out, subscribe to this channel. I put out new videos every week on the risks and opportunities most business owners miss. And leave me a comment. Which of these 10 indicators are you already tracking? Which ones are you realizing you need to start monitoring? What questions do you have about how to implement this in your specific business? I respond to everything, and your questions drive the content I create. Now go open a spreadsheet and pick your first 3 indicators, document them, start tracking them. Your future self, the one who doesn't have to deal with a completely avoidable crisis, will thank you.